प्रेजेंटेड बाय ईबिक्स कैश, हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Let's take you through the headlines. Markets mayhem. The Sensex tanks 525 points on global woes, closes at 58,491. Nifty slumps 188 points to end at 17,397. Good news for home buyers. Home loan rates slashed to lowest ever for the festive season. Sweeteners like zero processing fees tempt customers. There is good news for the salaried. A Deolitte survey says 92% of Indian companies plan to give an increment in FY22 versus 60% in FY21. Average increment expected to go up to 7.3% versus 4.4%. Indian politicians call the UK travel regime for vaccinated Indians racist and offensive. Vaccinated Indians travelling to the UK subject to multiple RT-PCR tests and 10-day hotel quarantine. Apple to launch new versions of its operating system iOS tonight. We'll tell you about the new features and upgrades. Profit booking coming in today amid weak global cues and news on Chinese developer Evergrande Group pulling benchmarks lower. Both the Nifty and the Sensex ending Monday session down, with the Nifty closing at 17,397. That's down 188 points. The Sensex lost over 500 points as well, closing at 58,490. The Bank Nifty was down 1.76% today. Tata Steel, JSW Steel, Hindalco, so the commodities, UPL, BPCL, some of the losers today, and bringing down the index quite a bit. Tata Steel was down 10%, JSW 7.7%, Hindalco 6.1%, and you can see a sense of really what really led to the weakness in trade. Meanwhile, other metals too, JSPL, NALCO, Steel Authority, NMDC, a whole host of them actually were completely battered in trade today. Cuts of about 7 to 10% across the board on those heavyweights. Few gainers though. HUL, ITC, so defensives once again. HCL Tech, Nestle up about 1% or so. HUL in particular was up 3% in today's session. Udayan Mukherjee, our global business editor, joining us on the show as always. Udayan, lots to talk about today with the markets, giving into profit booking after yesterday's euphoric rise and new records. Is this a little bit of nervousness ahead of the Fed's big meet tomorrow? Is that what the market's anticipating, or was this a correction long overdue and just a little bit of froth being chopped off?
Hi Abha. I think the market might be a little nervous ahead of the Fed meeting, but these could just as easily be excuses, because the market's gone up such a lot, and anything which happens on the margin can trigger something like the correction that we've seen today. But I also think that other than the Fed, which I don't expect to say something which will really roil market sentiment, because the Fed's been very careful about that over the last many months, I think the other thing which was brewing on the horizon is the issue with Evergrande, the Chinese real estate developer. It's a very large debt that they're carrying, $300 billion, and there are indications that it might go belly up. Now, people have memories of what even a single institution's collapse can do to markets and economies, so people are a bit wary about what's going on in China with this real estate episode. Maybe it is nothing, maybe it will blow over, it probably will, but for a market which has rallied a lot, these all become excuses to take in periodic corrections, and maybe this is something that we saw today, because locally I think a lot of good supportive things are happening for the market. You've seen or heard the government's announcements on the PLI scheme. There is some expectation that the Air India disinvestment might slowly be coming back on track. We've seen announcements on a bad bank, the telecom AGR dues, etc. So I think from a local perspective there is a sense that there is some kind of a policy momentum, and in the event of a global-led correction, these should all be supportive factors for the Indian market. But I think the space, as you correctly pointed out, to watch in the near term after today's correction would be the global space, because that will give us the signal on whether this becomes a more pronounced correction.
And now over to our global business editor, Udayan Mukherjee, to introduce our very special guest this Monday.
Hello and welcome to this Business Today Market Special. Every week we try and speak to one of the best and brightest minds from the Lal Street to try and get a sense of where this bull market is headed. Our guest today on the show is Rhythm Desai of Morgan Stanley, a veteran of several decades on the street and one of the staunchest bulls over the last few years. In fact, for the last many years, through many ups and downs, Rhythm has consistently been very bullish and has held the view that this is a multi-year bull market, which we are very much underway, and we probably are in the early stages of. Rhythm, thanks for joining us on the show, and it's good to speak to you again.
Thank you, Udayan. I'm very, very happy to be on the show, and thank you for having me on this.
Great. As I was saying in my introduction, that you are one of the really staunchest bulls for the last many years. And I know that your view is that this is a multi-year bull run. It's shaping up like that. But I want to start by asking you how you feel tactically about the market now after such a strong performance. Say between now and the end of the year, or between now and Diwali, how do you feel tactically?
You know, then calling markets for short term is really fraught with grave dangers of going wrong. But you know, I'll still take that risk. I go wrong very often, so maybe one more time. But yeah, we've had a very strong rally, and particularly in the broad market, things do seem a bit overheated. So I won't be surprised if we get some sort of consolidation or correction into the next few weeks. Sentiment looks a little bit overstretched. So yeah, it's good to have that, and it'll be healthy for this market if we get a correction. We're calling for one in the US. Our global team has actually downgraded equities to equal weight after being bullish for several months now since March of 2020. So yeah, I think the stars are aligned for some consolidation and correction. I do think this will be more intense at the stock level than at the index level. So you may not get the type of correction you want, say, in the Nifty. It could come, of course, but you know, the individual stocks could do a lot, and you should not be surprised if some stocks that have run up a lot go down 10-20% in the forthcoming correction, which is a pretty decent correction. So yeah, I think it may be underway at the individual stock level already, and maybe it extends itself just to make this market a bit more healthy. But again, as I said, calling tactical market moves is not my forte. Yet, I'm going ahead and saying this.
No, it's sporting of you to predict it. But if I were to push you a little further and ask you what you think the likely correction trigger could be, I mean, do you think should essentially be something global? I mean, something on the a message from the Fed, or something which is brewing on the horizon, like the Evergrande episode in China? Is there something which you can see which is brewing, which might trigger this 10-15% kind of tactical move down?
Yeah, so then I think it's largely global factors. There aren't any domestic factors that are bearish. In fact, the domestic factors are exactly the opposite. So I do see India outperforming in any type of global correction, which it is. It is actually, India is doing quite well. The S&P is already down from its highs, and it's at a monthly low. China has corrected a fair bit. India has actually done quite well. So that, I think, relative performance for India is intact, because India's own domestic policy momentum is far stronger than almost any other country in the world right now. So the correction, I think, likely comes from abroad. We've seen some regulatory tightening in China. We're seeing the prospects of another COVID wave in China, and China has a zero COVID policy, so it will come with some slowdown in growth that could spread to other parts of the world. More importantly, I think we're seeing some pretty big moves in commodity prices due to supply constraints. So, on one hand, you have the semiconductor shortages, which is causing outages for auto production. But on the other hand, you have these coal prices that are going up because of stringent environmental constraints in China, which then in turn is driving up electricity prices, which then is driving up aluminum prices because aluminum production is being curtailed. So it's then driving up natural gas prices in Europe. So there is, a bit of commodity price rise that's happening, which could then translate itself into a cost push. And suddenly, companies may face some margin pressure in the immediate term, and the markets will recognize that ahead of time and correct. So, and then of course, as you rightly said, the Fed is also there on the horizon. And there is a growing opinion, in the world that maybe the Fed is behind the curve. Uh, I'm not so sure about that, but maybe that also gets priced in. So these are all global factors that may play into their respective markets, China and the SPX, and then find its way into India as well. Because after all, we are in a relative world, and India is not a small market. It's the seventh largest stock market in the world. So it won't behave like a mid cap stock in the global equity space. It's going to behave like a large cap stock. So if global indices fall, then India follows suit.
Yep. Now let's come back to earnings, because this market has gone up a lot, and principally in the hope that the earnings cycle will turn around very soon and we'll see a lot of momentum that we haven't seen the likes of over the last 6 or 7 years in terms of earnings in India. Now, I was reading in one of your reports that one of your indicators, which is the leading earnings indicator, is actually predicting that over the next couple of years, earnings growth over a 2-year period compounded could actually be going up by 36%, or it could be going down 15%. So it's a plus 36 and minus 15, within which the range of earnings growth might oscillate. I mean, that's an unusually large range, minus 15 to plus 36. Could you talk a little bit about why there is such a large variance or dichotomy between the top and the bottom end, and which are the factors which could drive it towards each of these extremes? Because on that will hinge the final outcome for the market, right?
Yes, Udayan, and the reason why there is such a wide variance is because we are, I think, in an inflection point with respect to earnings. There's a lot of policy work that has been done over the past 2 years. It started in September of 2019 with the cutting of corporate tax rates, and it marked the shift in government policy away from boosting the share of labor in GDP to boosting the share of profits in GDP. And if you just tolerate me for a couple of minutes, the story goes back to 2006, 2007, when Manrega was enacted. That was a seminal moment with respect to policy choice in India. At that time, corporate profits were booming. Corporate profit share in GDP had gone to around 7%. And Manrega was a moment when the government of the day chose to transfer some of those profits to the labor class. Now, in India, that unfortunately doesn't work very well to drive GDP growth because we have excess labor. And any move to artificially boost wages, it results in inflation, which is what we got eventually once the dust settled on the global financial crisis. And in fact, we went into what we would term as stagflation by 2013. Now, it's taken a long while for policymakers to recognize that may not have been the right policy. For India, actually, where supply constraints are nearly the order of the day, the better outcome comes from boosting corporate profits, therefore investments. Therefore, you create capacity, then you create jobs, you create wages, and you create consumption. And then you get a virtuous cycle of growth. It was something that happened between 03 and 07 as a consequence of some really tough reforms that were undertaken by the government between 99 and 2004. And I think we saw that shift in policy in September 2019. And it wasn't a one-off. It's been followed by several policies which are directed in the same spirit of boosting the share of profits in GDP. Despite COVID, the government did not relent. So we saw both fiscal as well as non-fiscal measures, so new labor laws, production-linked incentive schemes. More recently, the revoking of the retro tax. We've seen the telecom package, the creation of bad bank. So a lot of things have happened over the past 24 months, which point to the government's commitment to boost the share of profits in GDP. If this commitment stays, then I think we are heading to the upper band. Something like, a 20, 22, 23% compounded annual growth rate in earnings over the next 3-4 years, I think could be the case. That takes the share of profits from 2% to say 4%. We still don't go back to the peak of 7, but we could still double in terms of share of profits. And if nominal GDP growth is say 10% and you just do a back of the envelope calculation, you get a compounded annual growth rate of 22, 23%. I think the market has got a little bit of a whiff of this. It's not oblivious to this. The market is damn smart. It gets this, and therefore share prices are trading, faster or higher than what the earnings change has been in recent times. Eventually, of course, earnings will catch up. If they don't, in the event that either you get a reversal in policy, or you get a event globally which causes global growth to slow down, then I think you go to the bear case scenario. And then earnings may not turn out to be the way my base case pictures it.
Do watch the full interview with Rhythm Desai on businesstoday.in. Tune in for his views on a whole host of things in conversation with Udayan Mukherjee. Now, corporate India handed over an average increment of 8% in 2021, and early estimates reveal that average increment for 2022 is expected to increase to 8.6%, in line with a healing economy and improving confidence. That's according to a Deloitte survey. As per the second phase of this process, Deloitte's Workforce and Increment Trends Survey 2021, 92% of companies gave an increment in 2021 at an average of 8%, compared with only 4.4% in 2020, where just 60% of companies had extended a pay hike. For 2022, average increment is expected to increase to 8.6%, at par with the pre-pandemic levels of 2019, according to the survey. About 25% of companies surveyed have projected a double-digit increment for 2022. Over 450 organizations participated in this edition, spread across 7 sectors and 24 subsectors.
The salary increase are showing a comeback as the business sentiment improves. Compared to what happened in 2020, when only 60% companies gave an increase and overall increase was muted to 4.4%, now we are projecting an increase of 8.6% in 2022. This is still early days and a lot will depend on how the next 4 to 6 months pan out. The fear of third wave has still not vanished, so companies are still very cautious. If we break down the broader industry in different sectors, we see that technology sector is leading the way as far as salary increments are concerned. Technology is the only sector where as of now we are expecting a double-digit increment.
Now, if you have been wanting to but hesitating to take a home loan for your dream house purchase, it's time to take the plunge now. Banks seem to be in a festive mood as well, and interest rates on home loans are at an all-time low.
Real estate was probably the sector hit hardest by COVID in the past 18 months. Already suffering due to demonetization, the twin lockdowns really took the wind out of home sales. But things are looking up this festive season, with banks sweetening the deal for home buyers. The country's biggest lender, SBI, has lowered its home loan interest rate to 6.7%. Punjab National Bank and the Bank of Baroda have also lowered their home loan interest rate. But the first mover advantage was Kotak Mahindra Banks, who was giving home loans at 6.5%. Just 2 years ago, the minimum home loan rate was 8.4%. That means there's an average drop of 1.9%. Translating this into hard figures, on a loan of 50 lakh rupees for a 20-year period, 2 years ago, you would be paying an EMI of 43,075 rupees. That amount now is 37,299. Similarly, over a 20-year period, you would have paid an interest amount of more than 53 lakh rupees. Now, it's a little less than 40 lakh rupees, a cost reduction of nearly 14 lakh rupees.
The person who's taking a home loan is going to benefit by the benefit of inflation in the future, and also, in fact, he has a negative real interest rate that he will be paying. So obviously, this will precipitate him to buy a house, take long-term loans, and also use the low interest rate and EMI in order to buy the house. Yes, it will definitely make a world of a difference.
There's more. Many banks have waived off processing fees for these loans and are offering the rock bottom interest rate for top-up and balance transfer loans as well. The festive mood is expected to overturn the impact of COVID. There are already signs of recovery, with nearly 100,000 units being sold in 6 metros in the January to June period, as compared to just 60,000 units a year ago. The sentiment is also improving, with 71% surveyed in metros looking for a house to stay in. Just 29% were looking for a house for investment purposes. What's more, there's been a 42% increase in those looking to transfer their loan balances and a 26% increase in home loan requests.
We believe as consumers go in for new homes and the demand for home loans pick up, we want to be an attractive option for customers. In that sense, we decided to drop our rates. The current home loan rates that we've announced are valid till November 8th. So they run through pretty much the whole of the festival season. After that, we'll see the trends, the interest rate trends in the economy, and take a decision after that.
Remember, there's always a catch. The minimum rates are only available to you if your CIBIL credit score is above 750. Also, the loan rates are directly linked to RBI's repo rate, which is at an all-time low. But when the repo rate rises, which it is bound to, your monthly EMI will also increase in a floating loan rate.
That's all we have time for on the show today. Thanks so much for watching.